Alrighty, we are ready to get going. How's everybody doing out there? Hope you are doing well. My name is Andrew Kuhn. Thank you very much for tuning into the Focus Compounding Podcast. Sitting alongside, across the table, from Geoff Gannon. Jeff, how are you doing over there?
I'm doing very well, Andrew. How are you doing today?
I am doing fantastic, ready to talk about some investing topic.
Okay.
This is the audio part of our business. If you do want to get access to our website, go to focuscompounding.com and be sure to sign up using the podcast promo code, which is podcast, and they'll take $10 off the monthly subscription price indefinitely as long as you stay a member. Good deal?
Mm-hmm.
Good deal. So somebody wrote into us on Twitter, which my Twitter is at Focused Compound, and Jeff's is at Geoff Gannon. That's Geoff Gannon. And I thought it was a pretty good topic to talk about. And he said, Warren and Charlie talk about the importance of temperament in investing. Can you talk about this on a podcast? So I said, okay, let's talk about it on the podcast.
Okay.
And that was from his handle is at MKONURI. So thank you very much for asking that. For people that do want to have certain questions, ask of us to go over on the podcast, feel free to tweet at us or email at us, info@focuscompounding.com, and we will go over them. So temperament. Pretty important topic, I would say, clearly, because things are could get pretty emotional when money is attached, and
sure.
Obviously it's something that a lot of people talk about, especially if you do follow Warren and Charlie.
Yeah, he talks about having the right temperament being more important than having high IQ.
Yep. So what do you think about that sort of topic, and when it comes to investing?
So honestly, I feel like I can't give advice on this topic.
Okay, podcast is over.
Podcast is over. Because people ask me this question all the time.
Yeah.
And they ask me something about my temperament, their temperament. They're like, I feel like this is different and stuff. So I've mentioned on the blog before and stuff that I was diagnosed with Asperger's, which is, if you've seen The Big Short or read the book or whatever, Michael Burry, that's a similar thing in some book that...
When were you diagnosed with it?
17 years old, I think,
17.
something like that. So this is, I don't know, more than 15 years ago, let's say.
Yeah.
And so for that reason, I think that some things that come easily to me do not to other people, and some things that come easy to other people do not for me. And in the case of temperament, I think that some things that are very difficult for other people are not a problem at all for me, just because of that. Most likely that. It can also be...
Like when it comes to investing? I mean, obviously we don't get too personal, but so when it comes to investing?
So I think a huge thing in investing, maybe the biggest for people, is not like that they fear volatility or that they fear losing money or something, but regret. Mm-hmm. And I don't have regrets.
No,
FOMO. No. And and similarly, people have a lot of, I guess you could say positive way, they have a lot of nostalgia and for things in the past that they like.
Sure.
Just like they have a lot of regret for things in the past that were bad, right? And they focus on that a lot. And I don't have any regret. It's just not something that... I lose money or make money or whatever, and I look back and say, what did I know at the time, and what did I do right, and could I have known, and things like that.
So purely for you, it's just a pure objective exercise, I guess you could say. It's
not very emotional at all, the concept of regret. No.
Yeah, and that's, I think, a pretty good trait for an investment manager, for sure.
And it's very, for a lot of people, it's a very big deal. Like the idea that they might have made a mistake.
See, I don't ever think about that.
No?
I mean, the mistake part maybe, but like FOMO, I don't really get a lot of that.
Okay.
Or if like I sell a stock and it just goes up a lot, I don't really think, if I'm just like kind of on to the next thing. That doesn't bother me. I don't really think about it. I certainly feel bad that way for other people in terms of like Weight Watchers, which I owned, and some other people follow me. Do you think you would have felt as bad if you didn't write about it though?
No, not when I felt as bad at all.
Exactly.
What I mean is I feel bad for other people, and not because if they lost money or they made money and whatever their situation was, but that it caused them so much emotional stress, these people. So much stress. It didn't cause me any of that stress.
Were you getting a lot of emails?
Constantly.
So
some people email me on a daily basis.
Were the emails stressing you out more? Or
No.
No,
they weren't stressing me out, but they were stressed out, but what can I do for them?
Yeah. Wow.
Yeah. So, yeah. And then, like, if there's no news or whatever, it gets like more and more. It's some of it in some cases where people almost getting more and more hysterical over time.
Wow.
Yeah, and not everyone was that way. So some people weren't.
So when people ask you about temperament, what do you typically tell them, or advice you give, or anything like that?
That's a really hard question.
Because it's not something you can teach. I mean, in my opinion. I think you could become more experienced, so maybe you just could develop more of a stomach for certain things.
Sure.
But you're born the way that you're born.
Right. And you can, I said Asperger's, which is a neurological thing, but it can also be for some people cultural. It can also be what they grew up in their household and things like that.
Sure.
So what were your parents like? What did they like kind of reward and not? What is your culture that you're in? We have a lot of people from different countries, and sometimes there's very big differences.
Oh,
on things
totally. I
about
could see that.
risk-taking, luck, regret, being able to admit a mistake that you have made, standing out in a bad way versus that not really mattering in some cultures, all those things.
Yeah. No, I think that's a good way of putting it. So if you had to give the picture perfect temperament for investing, if you were creating somebody yourself and you want this guy to be a perfect investor,
right? What
would you do?
Okay.
What certain traits, temperament level, etc.?
No regret.
Okay.
And also a sense of process over results.
I think that's
basically appreciation for noise.
I think that's beautiful.
That the idea that some of the investments that do work out were mistakes, and some of the investments that don't work out were actually good decisions that you made based on what you knew at the time.
Yeah.
A lot of times it's difficult because when I judge a decision that I made in the past, sometimes the conclusion I come to is different than what other people would think because I might be thinking of it more in terms of the process. So like I owned a stock, Barnes & Noble. Mm-hmm. And Barnes & Noble is a stock that I sold, and I consider a mistake for in terms of not understanding the human element of it, and I've talked about that. But I don't know if I lost 1% or something. I may have lost less than that if there was a dividend paid or something. But it was essentially a wash, right? But I consider it a very big mistake. But on the other hand, there was a proxy battle. And the Riggio family very narrowly won the proxy battle. So when you're going back in time and thinking in terms of like probabilities and things, you have to remember this was, even if you did make a mistake, we now know that they won the proxy battle and stuff, but there was some chance that they wouldn't, right?
Sure.
And so you have to factor that into your decision about the investment. And so what happened there is that I kind of had certain thoughts about what the business would be worth if they did not pour the free cash flow back into the Nook. Well, if they had lost the proxy battle, they probably wouldn't have. And there's probably some chance that even if they won, they would decide not to do that.
Sure.
Right? And I was right about the things that were not the Nook, right? And it would have paid off eventually. So it's hard to evaluate that. It's actually hard to tell, was that a mistake and how big a mistake was that?
Yeah.
But to so many people, and to a lot of people, what I'm saying is I lost, like I said, maybe it was 1% or something. The stock eventually, after years later and stuff, was down by a huge amount.
Sure.
The people who sold out, like when I did and stuff, may not give that any thought. The people who stuck in and it went down 50% and sold may think it's a terrible mistake that they made. But the initial decision is really the same in either case.
Sure.
It's just if you stuck with it.
The outcome, yeah.
Yeah, and I think too much people pay attention to that. And also then, of course, measuring. So we're talking about regret versus fear of missing out.
Yeah.
That's measuring yourself against other people.
Yeah.
So that's like envy and that's like things like that.
Well, that's what Munger says, envy is a sin, right?
Yeah, well.
It gets a lot of people in trouble.
Yes, and I think he says that it's the only one that you can't have fun doing.
Yeah.
All the other sins.
Yeah, that's the best part. I should
Yeah.
leave that out. I think, what's the worst thing that I think that can happen to an investor?
What?
Not the worst thing, but
Okay.
it's up there. It's him making money with the wrong process,
Absolutely.
where a lot of it comes from luck or, whatever, because that's only probably going to, kind of screw him in the future.
Yeah.
I think sorry, I didn't mean to cut you off, but
No,
we
go
talk
ahead.
about like focusing on the process, even if the outcome isn't originally or what you originally thought. If you focus on having the right process over time, you should do okay.
Yeah, I think that's absolutely true. And you had mentioned psychology and the mental models one.
Yeah.
There's some experiments done with pigeons actually, and they did they randomly gave them reinforcement. They gave them like a treat or something.
Yeah,
If
variable. I'm looking at the list. Variable reinforcement is actually on there.
So they pecked away. If I remember this, I think the original concept was to see if you could get pigeons to aim bombs for you. Okay, so the idea is they just have to peck in the center of a screen over and over again, peck on a target basically.
Sure.
Right? But by doing that, then obviously they're able to get them to continue to do it for a very long time.
Yeah.
In some cases, having very few treats allowed them to continue doing this for an incredibly long time when they were getting nothing back again.
Yeah.
So if someone has huge payouts, if they do something where they invest in some way where it's a 10-to-1 payoff early on, they may continue to use that process over and over again for an incredibly long time, losing more and more money. If the first thing you do is you go to the into a casino, you walk in, you've never been in a casino before, and you put down on a single number on roulette and you win.
Yeah.
The risk that you're going to keep playing roulette,
just leave. You got to get out of there.
It's bad, right?
Yeah,
and it's probably worse than the person who goes in there, plays and loses 5 times the person who wins and loses according to the casino's edge over.
I think a good way to think about it is Charlie oftentimes talks about Warren, how he was sort of harder to pull away from the cigar butt.
Yeah.
Because he was just so successful doing it.
Absolutely.
In that investing style for so long, or he made just so much money. Which, I mean, I think that obviously makes a lot of sense.
Right. Yeah, and he could have continued to do that if he did it at very small scale. He said before that it's the going with larger amounts of money. But I think that some experiences that he had taught him not to do that. I mean, part of it for Warren, I think, is that the ugly experiences of like having to basically liquidate a company or turn it around.
Yeah.
That it's not all just trying to make as much money as possible. It's also, I'd like life to be a little more pleasant than having to do those things. I don't want to be a liquidator.
What company was that? Was it Dempster
Mill probably was.
Yeah,
because
he said like the whole town like hated him, right?
Yeah.
And for someone that supposedly hates criticism like he does, that probably was a weird episode for him. Yeah.
Yeah. So, so I think, I'd say regret is one of the biggest one. Envy. What else do you think of temperament?
It's even little things. Like I think there's certain things you can do to sort of help your temperament level when it comes to investing. Like turn CNBC off. I don't know. I know for a fact you don't watch CNBC, but you look at CNBC, right? And what is it? It's just a bunch of noise and news and all these flashing tickers and it could really make people act sort of irrationally with what's going on.
It feels newsworthy.
Yeah. Could you imagine being an anchor on there? I mean, they're expected to know everything about everything.
Yeah.
It's funny. Everyone likes to sort of like joke about Jim Cramer.
Okay.
And I always sort of defend him. I'm like, you get up on TV and have an opinion about something every night. I don't have an opinion about something.
No, that's amazing what he does.
Yeah.
What he does is not
it's entertainment.
What we're talking about. Yeah.
Yeah.
But if you throw out a name, can he have a very strong opinion about any stock that you have?
Yeah.
You throw out a stock name to me, and I'll go,
no, that's not
I'll
the same
say
way.
That about things that I've looked at for hours and hours.
I say I have no idea. I have no idea.
I don't know.
Yeah, I always defend him. I'm like, you get up on TV and have an opinion about everything. But I think a thing you can do to sort of improve your temperament, which I understand it's not temperament,
right?
But turn off CNBC. Maybe try not to look at your account as much or all day, every day.
Well, some of those things you really can change the habits and the way that your brain works and looking at certain things that way. It can take time, but if you have a lot of habits that you react to some of those things, news things and stuff, I used to read a lot of newspapers and things, and I don't. And I'm not sure that I'll never read them again, but I used to be more like Warren Buffett that way. I read the Wall Street Journal, the Financial Times, the 2 local papers.
That's what Munger, they asked him at the Daily Journal what he reads. I think he said Wall Street Journal, Financial Times, New York Times, and the LA Times.
Yeah, when I was in New Jersey, I would read the Financial Times, the Wall Street Journal, the New York Times, the Star Ledger, and then a very local paper in New Jersey too. So, and I found over time that like the news aspect of it, I didn't like as much because it makes it feel like you should have an opinion about things that are current right now.
Yeah.
And what I found is like I had practiced doing some things where I would say, okay, well instead I won't read it today. I'll save it for the end of the week and then read it. And I found so often that by then it just didn't seem to matter as much. Yeah. What they thought was so important on Monday didn't matter as much on Saturday.
Yeah, right.
And that kind of taught me to not pay as much attention to news things that way.
Yeah.
And I've definitely changed in that way of that it's not as important to, you think that it's important to be informed and stuff, but it's more important to be informed in certain specific niches that you've picked out that you think are valuable than generally.
No, I think that's a good way of putting it. And when you think about like liquidity, how it could make people sort of act irrationally. Yeah. I love it when Warren said nobody buys a farm because they think it's going to rain next year.
Yeah.
When he said that, I mean, I thought that's the perfect analogy.
Well, I made this comment about a timber company that we talked about. And occasionally very illiquid timber stocks sell for less than the underlying timber does.
Yeah.
And the explanation is that it's illiquid. Now, the asset of the timber that's being traded in trades of, a certain number of acres. Say you want to trade, that you want to buy or sell 1,000 acres of timberland is obviously less liquid than the stock that owns 100,000 acres. But because it's a stock, people get so concerned about the liquidity, right? But you're not concerned about if you have a farm or a house or you actually own timberland yourself. You're not that concerned about whether you get a quote on it today and whether you can sell it. And related to that, I've talked a lot about people in OTC and illiquid stocks to be careful, because they'll talk to me and they'll say, "Oh, it went up 5%, it went down 5%. What's the news? Is something happening?"
Yeah.
And I'll say, "That's 100 shares that were traded."
Yeah, right.
And this person might own 5,000 shares. Why should we care that because the day ended and that was, what had been traded was 100 shares? You're taking their opinion about that when you own, many times what they own?
Yeah.
They're probably looking at yours and saying, "Oh, this person must know a lot because they're a big buyer in the stock or whatever." You know what I mean?
Uh-huh.
But there's a belief that people have about that, about markets.
Yeah.
And that's sort of what I mean about the noise thing. Essentially, a lot of that is noise.
Yeah.
And illiquid things can feel that way a lot because liquid and illiquid stocks, they follow kind of a random walk when other things aren't happening in terms of just what noise is. That's what it'll look like. And for illiquid stocks, it's not going to spend a lot of time in the things in between. So you're going to see a $15 stock go to $16 and then $14.50, and people will swear that there's an explanation there of what happened. Yeah. But if it's in Microsoft and it goes up by a fraction of a percent and then down and then up and then it doesn't feel the same way.
Yeah. No, I think that's a really good point. It's like when people talk about temperament, like you're saying, like there's an explanation. People always relate to like sometimes technical analysis and something like that.
Right. Because they're trying to see and that's the difficult thing is that we're both talking about something which is not purely, the stock market and the investments you're making aren't purely determined. They're not like a deterministic sort of game that you're playing, but they're also not a totally random one. Yeah. So like if you sit down at a chessboard and you play chess with someone else, all of that game is decided by the moves that the two of you made. There's no luck involved in it, right? Okay, it's complicated in a way. It could be hard to predict how it'll end up, but it's all determined by you. Yeah. But then when we're talking about casino games, craps, that's a totally random game, right? There's no skill involved, and you're just throwing dice, and that's what will happen. What you're actually seeing is something in between, and over shorter and shorter periods of times, it's going to look more like craps and less like chess. Yeah. But yet people will swear that it was like this decision that they made sometimes. The same way that, yes, it was a decision that you made in the chess game. That's why you lost it, right? But then logically it wasn't a decision you made in craps that you won the game, right? It's somewhere in between that. Yeah. And over longer periods of time, sometimes it's more determined those ways. But we're talking, there's a lot of noise. And so you have to think a lot about process and not about outcome because there's luck involved in it. Totally. The investments that I made the highest percentages on were, I would say, generally good decisions. And when I look back on them, I say that the process was right. But I also say that there was luck involved in them outperforming what I think on the probabilities they should have done. So I invest in Japanese net, and that did really well. I invested in a stock called Bank Insurance, did really well. In both cases, I'd say I outperformed what I thought the probabilities were. And I think that's what you would say is luck. It happened faster and bigger than I expected. But do you think that comes from having a good process? Yeah. But what I'm saying is I thought they should return 20 or 30%. They returned 40 or 50. Yeah. Right? But even that bothers people. Yeah. Because then you can't compare it to those things, right? Yeah, sure. So something I think should have worked out on average in 3 years happened in 6 months. Then you have an incredibly good result. But in your mind, you're remembering that as the most impressive thing you ever did. Yeah. And then you buy something else where you think there might be a catalyst. Nothing happens for 3 years. You thought it would happen in 3 years. Nothing happens for 5 years. In some cases, that's not really different, the two. There's a chance every year that something you think will happen within 3 years is going to happen this year. Yeah. And if it does happen this year instead of in year 3 or in year 5, then you're going to be amazed that you got this amazing annualized return. Whereas if it takes a little longer, it's not. It's true, right, that there are some things you could determine ahead of time that you could have figured out. Yeah. But some of it is just luck. No, I completely get that. Like I gave the example of the bank insurance thing. The truth is that here's to give you an example of how much luck there is. I wanted to buy that stock at an even lower price. And as it turns out, when you read the merger document, at the exact moment when I was going to try to buy the stock at what I thought was a really good price and I didn't get it at that price, the board was finally saying to the CEO, okay, you can now make your offer for the company and go public with it because the SEC thing is being resolved. I had no idea when the SEC thing would be resolved, any of that. So it's luck in terms of the timing. But if, on the other hand, if I had bought the stock not knowing anything, then the return would be even greater from that, right? So it all depends on those sorts of things that have to do with that, with the noisiness of it. But it doesn't change the fact that at all those different times, it was a good bet. It was the right stock to buy. It was the right probabilities favored it. Right. So, and sometimes you can know that you'll have a 10% or better return on average if this works over time, doing things like this, especially if you're doing 5 of these things, right? Yeah. But what you cannot predict is that this will be the one that does the 50%. And even like Buffett's partnership years and stuff, if you look at really what the record was, he has some stocks that seem to have done nothing for the year, and then they go up 100% that year. But he was in 5 different ones at the same time. They were all really good ideas, and then randomly something big would happen with one of them. Yeah. But you can easily fool yourself into thinking and seeing patterns in that randomness, right? Yeah. I mean, what do you think other than what I was talking about noise?
No, I think I completely agree with you. And I think one way, if I had to boil it down to sort of, because I'm just trying to think he asked, how can you improve it? Right?
Okay, yeah.
And I'm trying to think of ways that he could take away from it and how viewers can take away from it as well.
Mm-hmm.
And if I had to boil it down, what I think is a really logical way to looking at it is pretend that the stock market, your brokerage account, etc., is just a way to buy into, it's a liquid way to buy into a real business. So almost as if you're a minority business and you think about your portfolio as just a conglomerate that invests in public companies. And I think that's a good way of thinking about it. And that's that's the way I sort of think about it. And then I don't really care where the stock's going to be, today, tomorrow, next quarter. I mean, I hope it's going to be up, of course, right? Getting back to the variable reinforcement. But that's sort of the way I think about it. I don't know where any of the stock prices are going to be today, tomorrow, or even in the near future. But one thing I do believe in going in a lot of the companies that we go in is that the fundamentals are going to be better and that the business fundamentally is going to be a more valuable business. And if you believe like we do that, or like I do, and I know you do too, that stock prices over time tend to reflect value.
Yeah.
I think that's an incredibly logical way of thinking about it.
Yeah, I guess I have two pieces of advice. I don't know how good they are, but I think that they're specific, so you could try them out. One is keep an investment journal. And two is whenever you look at prices, just go into the chart and pick some amount of time. Could be a week, could be a month. Instead of thinking that last trade price, think what was the range for this month or whatever, right? And you'll realize that you'll be less fixated on this idea of a specific price at this moment or whatever. I've made this much money or whatever.
Yeah.
In reality, you could have sold at any time in that week.
Sure.
You're not timing things within a week, within a month.
Totally not.
So you could have gotten any price in that range. So if that range was that it was, $30 to $35, don't think I sold the stock at $35. Start to think, I could have sold that stock anywhere at 30 to 35.
Yeah.
No,
I think that's a great way of looking at it. Well, we want to thank him for asking the question. That was pretty good. And for other individuals who want to ask questions of us, feel free to email in or message us on Twitter, or you could also tweet at us, and we will definitely talk about it. So we want to thank everybody for tuning in today. If you do want to get access to Geoff's weekly memo that he sends out on an investing principle that will be in your mailbox on a Sunday, go to focuscompounding.com, and on the homepage, you will see a spot for you to enter in your email.
Yes.
And it's the memos are really great, and they've been really popular. And I like to say they're fun to read. Are they fun to write?
Are they fun to write? Yeah.
Are they challenging to write?
They're fun to write. Mostly it's rewriting them, not writing them, trying to fit them in that amount of time.
Yeah,
that space. Yeah. Because I like to keep them very pithy. I like to keep them short.
One page.
Yeah, one page. And usually I pick a topic that's too big. I have too much to say about it, and then trying to get it down that short. Yeah. Sometimes I think it's like maybe people need to reread this a couple times to get what I'm trying to say here. But yeah.
And if you do become a member, there's actually a database of all the past memos as well.
Yes, you can see all the past memos. They're archived there.
Yeah. So anyways, go to do that on the homepage if you do want to join that distribution list. Other than that, we will see you in the next podcast. Thank you very much for tuning in, and have a great day.